on A, I list down 1 to 9, where Australia government is very generous. Their department is called Australian Tax Office, in short ATO. They allow, of course, more than 9 expenses, but I'm just giving you these 9 major ones. There are many other expenses. Of course, some very creative tax consultant can create some scheme to do it, but those are not so sure. But all these one I have listed here are all dead cert. That means if these are the things the tax department will allow you to deduct from your profit, whether from your capital gain or from your rental income. Of all these, I want you to look at number 2. Number 2 is a depreciation allowance of house. In fact, in Malaysia and in many countries, the tax department doesn't allow depreciation. They allow depreciation of machinery, depreciation of cars, but they don't allow depreciation of house or apartments or landed properties. In Australia, this is one of the very good point, because the depreciation allowance they allow you is 2.5% a year, and you can do it for 40 years. It multiply up to get 100%. That means in 100%, you can write off your depreciation allowance and deduct it from whatever profit you derive, not only from your properties, and in some cases also from your salaries and etc. if you draw salary in Australia. So this is a very good point. In Australia, a lot of high salary people, they keep buying properties so that they get this depreciation. So this depreciation can be deducted or can contra against their salary. In other words, if their salary is 100,000, and if they can chalk up depreciation of 50,000, they only have to pay tax on the 50,000. So this is a very powerful tools, and this is one of the main factors which encourages a lot of Australians to invest in properties and a lot of foreigners to buy property in Australia. So what is this depreciation allowance? Depreciation allowance actually is more like the cost, the construction cost of the house. And I put here as roughly is about 80% of your selling price. In other words, if the selling price of a property is 500,000, 80% is 400,000, which means you can deduct 2.5% of 400,000. That means you can have 10% depreciation, 10,000 depreciation allowance. Of course, if you want to be very sure, you got to pay a couple of $100 to get a valuer to draw out a depreciation chart for you for the 40 years. Then from the chart, you will know every year exactly how much you can take this depreciation allowance. And why is it only 80%? Because they exclude, in the case of an apartment, exclude the cost of the land. Normally the cost of the land can be 10, 20, 30%. And of course, they exclude other things like common lift, common property, etc. That's why they only take 80% of the cost of the house. Not like a car. If a car depreciation allowance for a car is 10%, means 10% on the cost of the car, or on the selling price or buying price of the car. So, okay, this is the first main important parts where you can make use of the tax. So the next one is B.
At my website, you'll find online financial seminars, which is I call webinars. I do it regularly, and also a lot of online investment and financial courses, which is conducted solely online. So I'll be waiting for you at my website at KCLau.com. I wish you have a great day. Hope to see you soon. Bye bye.